Investing in stocks can be an exciting way to grow your wealth, but it's easy to make mistakes along the way, especially if you're just starting out. In this video, we'll highlight some of the most common pitfalls to avoid when investing in the stock market. From letting emotions drive decisions to failing to diversify your portfolio, these mistakes can cost you big time. Whether you're a beginner or looking to refine your investment strategy, understanding these missteps is key to becoming a successful investor. Let's explore how to protect your investments and build a more secure financial future. Today, we will talk about common mistakes to avoid when investing in stocks. So before we get started, make sure to hit that like button. Also subscribe to my channel. Investing in stocks can be a great way to grow your wealth, but it's also easy to make costly mistakes if you're not careful. Many investors, especially beginners, fall into traps that can undermine their long-term success in the stock market. In this video, we'll walk you through some of the most common mistakes people make when investing in stocks and how to avoid them. By the end of this video, you'll be better prepared to navigate the stock market and protect your investments for the future. 10. Not doing enough research. One of the biggest mistakes you can make when investing in stocks is not doing enough research. Too many investors jump into stocks based on tips from friends or trends they see on social media, without taking the time to understand what they're investing in. It's essential to research the company you're investing in, its financial health, the industry it operates in, and the overall market conditions. If you fail to do this, you risk investing in companies that may not perform well, leaving you with significant losses. To avoid this mistake, take the time to read up on the companies you're considering. Analyze their financial statements, check their performance history, and understand their future potential. This knowledge will help you make more informed decisions and avoid putting your money into risky investments without a solid foundation. 9. Letting emotions drive your decisions. Emotions can be your worst enemy in investing, whether it's fear, greed, or excitement. Allowing your emotions to control your investment decisions can lead to poor outcomes. For example, you might panic and sell your stocks when the market drops, even though it might be a temporary dip. Alternatively, you could be lured by the promise of quick profits and make impulsive investments without thinking things through. The key to avoiding emotional decisions is to stick to your long-term strategy. If you have a clear plan and know what your goals are, it's easier to stay calm during market fluctuations. Always remember, investing is a long-term game, and short-term market movements shouldn't dictate your decisions. 8. Failing to diversify your portfolio. Another common mistake is putting all of your money into one stock or one sector. While it's tempting to invest heavily in a company or industry that you believe will perform well, this strategy can backfire. The stock market is unpredictable, and if the stock or sector you've invested in takes a hit, you could suffer significant losses. To avoid this, make sure to diversify your portfolio. Spread your investments across different stocks, industries, and asset classes. This reduces your risk because if one sector or stock performs poorly, the other parts of your portfolio can help balance out the losses. A diversified portfolio is one of the best ways to protect yourself from the volatility of the stock market. 7. Not having a clear investment strategy. Going into the stock market without a clear strategy is like driving without a map. You might get lucky sometimes, but more often than not, you'll end up lost. Without a solid investment strategy, you're more likely to make hasty decisions based on short-term market movements rather than long-term goals. To avoid this mistake, take the time to define your investment strategy. Are you investing for retirement? Do you want to generate income through dividends? Or are you looking for long-term growth? Once you have a clear goal in mind, it will be easier to choose investments that align with your strategy. Consistency and discipline in following your strategy are crucial to achieving long-term success. 6. Overlooking fees and expenses. Another mistake that many investors overlook is the impact of fees and expenses on their returns. Brokerage fees, management fees, trading costs, and other expenses can add up over time, eating into your profits. While these costs may seem small at first, they can significantly reduce the total return on your investment, especially if you're investing for the long term. To avoid this, always pay attention to the fees associated with your investments. Choose low-cost brokerage accounts, index funds, and ETFs that have minimal fees. Be aware of hidden fees that can erode your gains and factor them into your decision-making process. 5. Ignoring the power of compounding. Many investors underestimate the power of compounding when it comes to building wealth. Compounding is the process of earning returns not only on your initial investment, but also on the returns you've already earned. This can lead to exponential growth over time. However, if you pull your money out of the market too soon, you miss out on this incredible growth opportunity. To avoid this mistake, be patient. Let your investments grow and allow the power of compounding to work in your favor. The longer you keep your money invested, the more it can grow. Even if your stock investments don't show huge gains in the short term, compounding will help your wealth build over time. 4. Trying to time the market. Trying to time the market is a trap many investors fall into. The idea is to buy stocks when the market is low and sell them when the market is high. In theory, this sounds great, but in practice, it's incredibly difficult to predict short-term market movements. No one can accurately time the market consistently, and attempting to do so can lead to missed opportunities and unnecessary risks. 3. Overestimating risk tolerance. It's common for new investors to overestimate their ability to handle risk. Stock investing can be volatile, and while higher risk can lead to higher rewards, it can also lead to greater losses. Many investors, especially beginners, take on too much risk because they're excited about potential returns. This can lead to stress, panic, and rash decisions when the market turns against them. 2. Chasing hot tips and trends. While it's tempting to jump on the latest stock trends or take advice from hot stock tips shared on social media or by friends, this strategy can be dangerous. Chasing trends often leads to buying stocks at inflated prices, and if the trend fizzles out, you're left holding an investment that's lost value. 1. Failing to stay informed and review your portfolio. The final mistake to avoid is failing to stay informed about your investments. The stock market is constantly changing, and what works today may not work tomorrow. It's essential to regularly review your portfolio, stay updated on market trends, and adjust your strategy as necessary. Investing in stocks can be a great way to build wealth, but avoiding these common mistakes is key to long-term success. Remember to do your research, avoid emotional decisions, diversify your portfolio, and stick to your investment strategy. With patience, discipline, and a clear plan, you can make smart choices that will help you achieve your financial goals. What do you think of our video? Let me know in the comment section below. Before you go, please hit the like button and subscribe to my channel. Thanks for watching.